Welcome to Catalyst Corporate and Catalyst Strategic Solutions 2015 Blueprint for Success. I'm Jane McGarry, your moderator for today's presentation. In looking back on the events of 2014, it looked like the economy was heading in the right direction. In 2015, the U.S. economy will continue to strengthen. It could also be the year that interest rates start to rise. This, of course, would have a dynamic impact on credit unions. To assist credit unions in navigating the impact a changing economy presents, Catalyst Strategic Solutions has assembled a panel of balance sheet experts to discuss the key issues facing credit unions in the year ahead. Our panelists for this year's Blueprint for Success are Stephen Houle, Catalyst Strategic Solutions Director of Advisory Services, Mark Debris, Catalyst Strategic Solutions Director of ALM Services, and Serena Friedland, Senior Investment Officer for Catalyst Corporate. Serena is going to kick off our discussion starting with an overview of the key economic indicators to watch in 2015. Serena, what were the key economic events of 2014?
To me, there were four key events. The first one we're dealing with right now is the drop in the price of oil. Oil fell 34% last year, and what that means to you and me is a drop in what we pay for gasoline. We are at the lowest prices since 2010, I believe. Basically, we got a tax cut. We are now paying half of what we paid earlier this summer when we go to fill up our car, which is tremendous. I mean, it's just, not only is it a financial boost, it makes you feel better, and you don't mind spending a little extra on whatever else that you weren't going to spend before. That has added a lot to consumer spending this year. In fact, it added 3% to overall GDP in the third quarter, which is huge. The second key event that I believe is jobs. We've all been concerned about the job market. We've made tremendous strides this year. The country has added over 3 million jobs this year. Unemployment rate fell from 6.7% to 5.8%. We're back to almost pre-recession levels, which is tremendous news. There's still weakness in the job market. There's still a lot of slack, plenty of people looking for jobs, but we're headed in the right direction. The next event that was important that's actually been going for a few years is just pure economic troubles across the borders. You've got Russia, Japan, China, the whole European zone area. They continue to struggle in getting their economies back on foot. I mean, ECB actually began quantitative easing this year. We finished it, they started it. You can see the troubles they're having. The last important event, especially for myself, because I am an investment person, I like the Fed. This time last year, we had a new Fed chairman come into office, Janet Yellen. With any new person, you wonder, what is she going to do? Is she going to keep the same policy? Is she going to change it? What's going to happen? Well, we did get an end to quantitative easing in October, which was great news. What we have not gotten, and the market does want, is a change or an increase in interest rates. They've alluded they may start raising rates this year, but we'll talk more about that.
We'll see what happens.
Yes.
So, will economic growth continue to improve in 2015? If so, what areas do you think the growth may be realized in?
We definitely will see some growth. 2014 was a pivotal year, and I think 15 is going to carry that momentum forward. There's a couple areas that I think were strong last year that continue to be strong this year. The first one is housing. So much that goes on in housing affects the rest of the economy. Housing wasn't great in 2014. They call it a sideways year, a lot of ups and downs. I think, though, it put us on more of a stable footing to go forward. I tend to look at existing home sales as sort of a monitor for the industry. Existing home sales make up 90% of the housing market, which is basically the home market. Existing home sales were only up just about 2% or so last year. That wasn't very good. So you would think it's not on good footing. However, the important part there was the number of existing home sales available for sale now has declined. And what that means is we've gotten rid of all the carryover from the recession. All the foreclosures, the short sales, that's gone. The investors are pretty much out of the market, and what's left is, to me, a more realistic housing market for us, the consumers. The good thing about not having all the homes for sales, like I said, we're in a better framework for it. Right. I think we'll see builders come back in and switch from building the high-end homes more to the homes that for middle America that we all can afford, especially for the first-time buyers who may want to now get out of renting and move into buying homes. The bad thing there that could be is with less supply at first, it could raise prices a little bit more. So you could see some price pressure for those people coming into the market. I don't think that's going to last too long. I think once the builders get in there, it'll equalize a good bit. The next area that I think is really going to be a good spot for the economy is manufacturing. That was a shining spot in 2014. It really propelled the economy stronger. What drove that was basically auto manufacturing. This country loves new autos. They do. There's a population that is out there buying every new car that comes to market. With technology making such tremendous advances, there's some new bell and whistle in every new car. I mean, they're already talking about driverless cars in the future, which I don't think I'm part of, but that's down the road. You see where we're headed with that. So auto manufacturing is going to continue to propel that market. The other really nice thing about having that new car market so strong is if you're buying a new car, well, you've got an old car that's now a used car. That actually is great for credit unions. Credit unions do a lot of lending in the used car business. So what I see is not only do you have the pool of new car buyers needing loans, you have these other people who are looking to buy used cars. Great source for loan demand for credit unions. So I think that's going to help them a lot.
So based on those comments that you just made, what do you see happening with household net wealth and with consumer spending?
Spending is going to keep going. It's just hard to keep us down. We're feeling a lot more confident. Consumer confidence is at seven-year high. We feel better about the job market. We've got that extra money from not having to put into our car or our gas pump. So consumer spending is going to be stronger. It's going to keep in every area you can think of. On the flip side, net wealth is probably not at its strongest. That might be the one weak point. I mean, if you look at the stock market, it had a great year last year. If you gauge your wealth by that, you're probably doing okay. That's not realistic to me. Wages have been very slow to appreciate, even with jobs. Employers have become very efficient with their employees. They could get a lot out of us. They've been able to keep prices down. However, what we are seeing, there is an index that actually measures how much, or the number of people who willingly leave a job for another job on their own accord. That index is actually increasing. So what that tells me is people are feeling better about leaving a job to get a job that gives them more experience. It's going to give them more money also. So you're seeing that pressure on the employers. I think this will be the year that they give back to the employees, the way I say it, and they will start increasing wages to get more workers, more skilled workers, to keep that going.
Mark, I saw you nod your head.
Yeah, no, there were just a few things I wanted to build on that. Is that, you talked about the tax cut to the consumer of the price of oil coming down so much. And we're looking at oil prices are down significantly over the past 6 months. Now, historically speaking, every $10 decrease in the price of a barrel of oil has added about 20 basis points to bottom line GDP. And so I do expect that it's going to help continue to propel consumer spending as we go into the years ahead. But on the flip side, for credit unions, there's still what's going on is that with the price of oil coming down so much, that the areas of the U.S. economy where fracking has been really big and really strong and generating a lot of employment growth, those areas we may start to see a little bit of a slowdown in terms of the employment side. And so if you're a credit union that has a field of membership that's doing a lot of fracking and in the energy sector, especially out in West Texas and North Dakota right now, you may see a slowdown in terms of deposit growth, but also in sort of the loan demand that you're going to see going forward.
Serena, what about the yield curve? What do you see happening there?
The yield curve has definitely flattened this year, and I think we'll continue to see it. When I talk about the yield curve, I tend to talk about the difference between the 2 and the 10-year, and that's typically how people talk about the market. That curve has flattened about 100 basis points from the year before, from 2013. We closed 2014 right about 150 basis points. A lot of that flattening had to do with the 10-year. The 10-year sort of works on its own. It does listen to economic data, but it has a lot to do with the level of inflation. It reacts to price pressures. Well, with inflation pretty much being non-existent, that 10-year note has been artificially kept much lower. Because our economy is so much stronger than the rest of the world, which I talked about, we've seen foreign money pile into the U.S. bond market. That, again, has kept the interest rates low in the 10-year. The Treasury market is what we call the flight to safety haven. Whenever there's any kind of fighting, political problems, even a bad day in the stock market, money will come into the bond market, again pushing that yield down. that's really evident if you look at even a month ago in December when the GDP number came out, the 10-year popped up to almost 230, close to it. Okay, things are looking good. This week alone, because of the international problems going on, that 10-year is back down to a 191. That's a huge drop. So you can see the volatility there. Credit unions tend to look at the yield curve between the 3-month and 5-year, so I just want to mention that for a second. That is much more in line with their funding and their lending requirements. That particular curve has stayed very flat, right around 160 basis points. I don't think we'll see that change too much next year unless the Fed really gets aggressive in raising rates, which I don't think they will.
What changes are you seeing in the investment sector?
Investment sector has definitely changed over the last 5-6 years. Mainly it's the appetite of the credit unions. Two things have been working against us. Mainly yields have stayed low and the spreads have narrowed. And the spreads have narrowed because there's just not enough supply out there. Take agencies, for example. Fannie Mae and Freddie Mac, they've been winding down their balance sheets for several years now, which means they do not need to issue as much debt. Less supply, still the same demand from the investor. They can make it more expensive. What they do is they tighten the spreads in. So even if interest rates do move up a little bit, you won't see the yields on the bonds move up quite as much. Now with CDs, it's a little bit different there. We've seen not much supply. Loan demand has been down for a few years. Now that loan demand is picking up, banks and credit unions actually need more funding to make the loans. So we're seeing them get back in the game of issuing CDs. Credit union CD alone within our program increased 40% last year, which is a huge rate of growth. So given that, yields have actually gotten a little bit higher. You've got more supply out there. In many cases, depending on the size investment you purchase, CD yields are actually better than agency yields right now. So credit unions need to look at all the options out there and really go for what's giving the best yield. The last thing about the changes in the investment scenario is I do believe credit unions are going to start focusing more on rebuilding that short-term ladder, which means they're going to be using the CDs to kind of put into that 1-2 year area, and that's for liquidity. As loan demand's increasing, credit unions' liquidity is going down, so they need to find some way to assure they've got even cash flow. Rebuilding your short-term ladder is going to help them, as well as if you want to get that little extra yield kick, move into mortgage-backed securities, which a lot of credit unions have been doing now. Mortgage-backed securities give you a monthly cash flow. So you've got monthly funds coming in, which will help with your liquidity situation.
Stephen, your thoughts on that?
Yeah, I mean, I agree with Serena. I think she's hit on some of the key points. One is the fact that the yield curve is flattened. I think that is critical for credit unions. I think the other thing that it really opens up is where do credit unions want to be on the yield curve? Obviously, as the yield curve changes, that dictates duration strategies, yields on those curves. But I think what was critical and what Serena said is focusing on cash flow and predictable ladder. And I think if you use all of the instruments available to you, that will be certainly helpful. That will ensure that predictable nature of your investment portfolio. And I think that's what Serena's really hitting on.
It sort of ends it on a positive note. Thank you, Serena, for all those insights. It sounds like 2015 is full of promise and offers opportunities for credit unions. Let's turn to Stephen now for a look at lending and rates. Stephen, what was loan growth like in 2014, and have we seen changes in the composition of credit union lending portfolios?
Loan growth was strong in 2014. We saw 10% loan growth through September. That's fantastic. Now we're going into the 4th consecutive year of positive loan growth. Back in 2010, loan growth for the industry was negative 1.3%. So you can see how far we've come as an industry in the last 4 years. Also, if you look at loans to assets, we're at about 63%. 2 years ago, we were below 60, so in 2 years, we've made good strides there. And back in 2009, loans to assets was about 65%. So we're slowly making our way up where we need to be. The only concerning trend within loan growth is the fact that smaller credit unions are still seeing negative loan growth, which continues to cause obviously some heartburn for the smaller credit unions, and hopefully that trend changes. As far as composition of loan portfolios, real estate loans continue to be over 50%. So I think this year we're going to finish with about 54% in real estate loan allocations. 2009 it was very similar. But obviously, with a potentially rising rate environment, that is an area of risk management, looking at interest rate risk, and with real estate loans being 50%, there's certainly more scrutiny there in the balance sheet.
What impact on earnings have we seen over the last few years as loan portfolios have continued to reprice lower?
Right. Actually, earnings this year finished at about 84 basis points return on assets, which is phenomenal. Back in 2010, we were at about 52 basis points, I believe. So we've seen some nice increases in return on assets. The unfortunate thing is it's not coming because of higher loan yields. In fact, when you look at the yield on loan portfolios, that's continued to decline in the last 4 years, about 32 basis points a year. We've seen loan portfolios decline. So this year, we're seeing loan yield of about 4.80. Where credit unions are making up the difference to see that growth in return on assets is through lower provision expense, actually higher investment yields, like Serena was mentioning. We have investment portfolio yields at about 124. Last year, we hit a bottom in investment portfolio yields, and that's starting to increase, and also low cost of funds. So it's not necessarily coming from higher loan yields. In fact, loan yields continue to trend down, which again, I don't know if we've hit the bottom yet. When you have vehicle loan rates at below 2%, you have mortgage rates below 4%, naturally you're going to continue to average down. So hopefully we see improvements in 2015, but that's certainly an area of concern.
So if you can give me some perspective on all of this, the economy and industry are a few years removed now from the financial crisis. Would you say the overall loan quality has improved and is going to continue to improve?
I think loan quality is going to continue to improve. Serena mentioned, members' household wealth, balance sheets at the member level. Obviously, members have continued to pay down debt. Credit unions have been able to, work through some of the troubled loans and whatnot. If you look at delinquencies and charge-offs, those continue to trend down. I think collectively combined delinquencies and charge-offs are about 1.3%. Back in 2009, they were at over 3%. So we've seen almost a 55% reduction in delinquencies and charge-offs in the last 5 years. Furthermore, if you look at provisions for loan loss, we're at 26 basis points. Back in 2010, we were at about 78 basis points, I believe. And you have to go back to 2006 when provisions for loan loss was still 32 basis points. So over almost, an 8-year window, we are at the lowest level. So I think there's reasons why we can be optimistic. Loan quality is going to stay, impeccable. On the flip side, it also maybe shows that credit unions need to do more lending and open up the credit standards a little bit so that they can make loans on the lower grades of paper where the yields are higher, and those are opportunities, I think, in 2015.
So you mentioned lending. What do you think we can expect lending to be like in 2015?
I think lending is going to be 10% at least. I think we can certainly hope for that. There's certainly been positive signs in the economy. Liquidity profiles at credit unions are good. Credit unions want to make loans. Members, want to be making borrowings. If you look at vehicle sales, in November we had vehicle sales of about 17.1 million units. That's on target to match second quarter's annualized numbers of 16.7. So you can see auto numbers are extremely strong. That's the bread and butter for a lot of credit unions. So I think there's opportunity there. Myself, I've just purchased a new vehicle loan after about 11 years of having a vehicle loan. So I think there's a lot of pent-up demand in the industry for vehicle loans. I think real estate loans are still going to be strong. Obviously, with real estate loan rates hovering at historical lows, that gives incentive for mortgage buying. So I'm hopeful. I'm thinking 10% on the scoreboard.
For credit unions that continue to struggle, and there are some, to make those loans, what recommendations do you have for them?
Well, I think credit unions that are struggling, I think you want to step back and you want to look at whether the struggles are organic, so whether it's coming from pricing, do they understand the pricing of the loan structures? Is it an unwillingness to make some of the lower grades of paper? And I think if they can get over those hurdles, there'll be opportunities for them. I also think that helping them understand the overall picture of the balance sheet, the concentration risk is critical. I also think if credit unions are struggling organically to make loans, Obviously, there are other channels that they can go to. Indirect lending, for instance, has been extremely popular in the years. You know, in the last 3-4 years, we've seen about $60 billion of indirect auto loans come back on credit union balance sheets. So credit unions are going back to indirect auto lending. I think the key in that program, though, is understanding the fee structure and also realizing that the charge-offs are going to be higher in an indirect program. In the last year, since 2013, there's been an uptick of about 20% in charge-offs from indirect portfolios. So I think if credit unions are going to go there, they've got to understand the pricing and they've got to understand that there's probably going to be higher charge-offs. Furthermore, I think there's other programs such as loan participations. Loan participations are a great opportunity for credit unions that want some loan growth. Again, with that program, I think understanding the dynamics between pricing, prepayment speeds, and charge-offs are critical. So just looking at the overall yield performance of those loan participations.
And given that, being on the investment side, I've seen a big trend of credit unions moving toward loan participations to replace what they would normally be buying in investments. They're getting a little bit more yield. It's helping their loan portfolio if they can't make their own loans. This is another way to put that on the books. So I've definitely seen that trend going toward loan participations.
Yeah, and I think on that point, there's certainly opportunity to diversify from a geographical standpoint with loan participations, as well as products. So if a credit union has a lot of opportunity in real estate loans and they want to supplement the balance sheet with auto loans, there's an opportunity there. If they want to diversify geographically, there's opportunities there.
Exactly.
So, Mark, you
Yeah, I was going to say something as well, is that, you know, when we're talking about ways in which we need to drive a little bit more loan growth at a credit union, Stephen already touched on, is that most of the credit union's members, their balance sheets are a lot healthier now than where they were several years ago. And so as we go through and we as a credit union taking a look at loans, we've seen a lot of credit unions have a lot of success getting into that B paper and even into the C paper loans, you know, with our members, yeah, they're still there, but they are a lot better off than where they were 5 years ago when we came out of the Great Recession, right? And so I think that it's an opportunity that a lot of credit unions are still scared. A lot of credit unions got burned really bad in terms of credit losses and everything else over the last couple of years. And so don't be terribly afraid to dip your toe back into that water.
So, what additional strategies do you have that could improve lending growth?
Well, I think there's some simple ones. I think if credit unions are looking at their membership database, you know, how many of those members have loans elsewhere that they can recapture for the credit union? I think that's key. So data mining your membership. I think another one is very simple: outbound telemarketing. You know, how many times, you know, if you were to just call that member, strengthen the relationship and see what needs they have. They might need a loan that you don't know about. So I think outbound telemarketing is key as well. And then looking at, you know, optimizing your marketing dollars. Okay, so what marketing strategies have been effective, which ones haven't, and then optimizing those. Okay, so, you know, going with the ones that I think have given you the most bang for the buck.
And going from a risk management standpoint at this point, what would you recommend credit unions consider or keep in mind as they structure their loan portfolios?
Sure. I know Mark's probably going to touch on some of this, but I think some of the key things would be understanding, you know, asset allocations and concentration risk, looking at, you know, loans as a percentage of net worth and equity, also looking at liquidity profiles. So what kind of liquidity does that asset provide you? Also, what's the overall liquidity profile of the credit union? Does that help you or does that hurt you, that type of loan or asset type? And then also looking at some of your key risk metrics, your interest rate risk, your earnings risk. So what assets do you have that drive the most risk from an earnings and a market value standpoint? So I think that those would be critical. Concentration, liquidity, and earnings.
Thank you, Stephen. It looks like credit unions can look forward to another strong year in lending and are encouraged to maximize all opportunities while keeping a close eye on balance sheets. Next, let's hear what Mark has to say about liquidity, credit risks, and regulatory concerns. Mark, you talk with credit unions all across the country. Is there any trend or consistency in terms of what examiners are looking at or focusing on these days?
Yeah, absolutely. If we go back over the last couple of years, we know that the three big things that examiners have been hitting credit unions on are interest rate risk, concentration risk, and then this year, liquidity risk. And, you know, as we go into 2015 and even into 2016, I think that we're going to see more of the same, to where you know, we're going to still be held accountable for concentration risk and interest rate risk, but I expect liquidity risk to become a little bit more to the forefront of what it is that credit unions are going to be regulated against. I mean, even in earlier 2014, we saw that, you know, new regulations requiring liquidity risk policies have come out, and so I just, to me, everything it is that I see suggests that that's going to be, you know, the big emphasis going forward.
What trends have you seen in terms of loan portfolio allocations, and what are the major concerns?
Yeah, and that's kind of been the big question, you know, and the big issues with our examiners, but also, you know, as consultants that work with credit unions. And, you know, if we go back to the beginning of 2003, we can take a look at what's happened within the loan portfolio, and what we've seen is that, you know, auto loans, which used to historically be the bread and butter of the credit union loan portfolios, has started to decline as the share of the overall loan portfolio, to where about this, you know, kind of mid-2007 time period, we saw all of a sudden the relationship between auto loans and mortgages switch, to where at the end of this past September 30th of 2014, we saw that the real estate loan portfolios were now, you know, hovering around 40% of the total loan portfolios, where the autos were about 30%. But even building on top of that, the investment portfolio side, which is the other big asset side of the balance sheet, we saw investments where they used to be 80% were about that 0 to 3 year bucket, where, you know, you had about 20% being everything else. That those shorter term investments have started to come down, and we saw longer term investments also begin to represent a larger portion of the overall investment portfolios. Now, even kind of building off of that, you know, you take a look at the yields. Yields have been terrible within the investment side, but also in the loan portfolio side. And a lot of credit unions, you know, with interest rates coming really, you know, way down, your members walk in, they want a mortgage, right? And as a credit union, your job is to meet that loan demand.
A major fear of a lot of people is that interest rates will rise quickly. What are the main concerns associated with interest rates right now, rising interest rates specifically?
Right. You know, and I think that's where kind of this liquidity risk really starts to take center stage. In that, building off of the previous answer, where we talk about the changes on the loan portfolio, but also the investment portfolio, some of the big fears and some of the big concerns have to do with how is a credit union going to be able to adjust their deposit rates as interest rates begin to rise. And some of the concerns that I have, and I know also in speaking with some of the examiners at NCUA, is that the fears are because credit unions went so much further out on the yield curve in the loan portfolio, but also the investment portfolio, that their asset yields are going to be slow to respond and rise upwards. And if that happens, then all of a sudden we start to see the overall market interest rates increase. There's going to be competition. Competition is going to, you know, force a credit union's hand to start to look at raising dividend rates and raising what those deposit costs are. Now, does a credit union have the capacity to do that without crushing their earnings too quickly? And if they don't don't respond and raise dividend rates, are they going to see some of their deposits walk out the door? And if that happens, where do they stand in a liquidity position? Do they have enough cash on hand to fund those withdrawals? Or are they going to be looking at possibly getting into a borrowing situation? You know, one of the big fears is not so much that it'll happen overnight, but being prepared for it, right? Is that we still have some time to adjust, and there's a lot of time to plan for this.
Serena, I saw you shake your head. What was that about?
Well, this hits home with what I do. Mark was talking about how credit unions can kind of work with their funding needs. What we've seen with interest rates being low still, it's a great time for credit unions to try and issue CDs on a national basis, not go to their member base. Problems with going to your member base is they're waiting for yields to go up. They want to wait till the Fed does their thing and yields get higher before they start putting money into a 2, 3, 4 year CD. If credit unions go ahead and, let's say, use a Simplicity program to actually issue CDs nationally across all, so it reaches all credit unions in the country, they can stand to bring in deposits now, take advantage of rates still being low before they jump up, and really secure some long-term funding at very inexpensive rates. The other thing credit unions can do is use their investment portfolio. They buy agency securities, extremely marketable bonds. They can be sold in a day, within an hour. Have at least a few agency bonds in your portfolio, depending on the scope of your credit union, at least ready to be sold at any given time.
Great point. So,
yeah.
Mark, with the potential problems looming, what do examiners want credit unions to do, and what in reality can they do?
Yeah, and then kind of that balancing between the balancing act between what the regulators want and then what a credit union can really do is really kind of where we walk a fine line from the consulting side. You know, the examiners, if you really talk to them, it's what they're really looking to do is make sure that the credit unions understand the level of risk that they have on their balance sheet. They're able to put together a plan to manage against those risks, and then they ultimately enact those plans, right? And then it's not only that, do they have the process down to where they document exactly what it is they're going to be doing? And so that's the pie in the sky ideal, right? But we have to remember that credit unions are in the service industry, right? You know, they're
Right.
there to service their members, and they're a member-owned entity. So, you know, and I was talking with a couple of credit unions and some that we work with, and listening to them, it's one of the things to where they struggle with. It's not very often when a member walks in looking to get, you know, a mortgage loan, and you know, you can turn around and say, well, hey, how about we sell you, you know, get you a car loan, and you can get a van and sleep in there. There's not many people that are indifferent between sleeping in a house or sleeping in a van. So, you know, when you look at it, there's this dichotomy between what everybody wants and what it is that a credit union can really do. Now, the big thing that what a credit union can do, and this is what I think the examiners are really pushing for, and also what I've been recommending, is getting more towards this risk-based decision-making process, to where they start to evaluate the overall interest rate risk reports that they are getting, understanding them, but not just understanding the reports, understanding where your risk is coming from, why it's coming from there, and then ultimately, are you comfortable with how much risk you have on the balance sheet? The second part gets into what are your expectations for the future, and then ultimately, what do you do about that?
You mentioned the word risk. What are the key considerations in risk-based decision making? How the risk reports can be used in the decision-making process?
Yeah, and I touched on that a little bit already. Is, you know, and this is where you get the ALM reports you have. In so many credit unions, it's a lot of numbers and it's a lot of math that goes into them, and you know, not everybody understands them. You know, luckily for myself, I happen to work with them all day, every day, and so I become extremely familiar with them. What you really need to be able to do is break it down, and Stephen talked about it earlier, where understanding what's driving your earnings versus how much risk are those components adding. You need to be able to identify those. Are you comfortable with that? Where is your risk coming from and why? Do you even know? Did you know that in advance when you're putting that risk on your balance sheet? And then the second part talks about the economic outlook, right? Where do you expect interest rates to be going? When do you expect them to increase, and when do you expect them to fall? You know, there's a timing, and you got to bring all of those pieces together. You know, Serena talked about the economic outlook, right? And so there are some expectations out there that rates we're getting closer to that point where interest rates begin to rise. Now, if you're a credit union and you have too much risk to rising interest rates, and you want to manage against it, then time comes to where we start to make a decision and put together a plan for what kind of strategy are we going to enact in order to address that.
So Mark, are there key economic indicators, if you will, that credit unions should watch for? Are any of them more important than others?
Yeah, I think that if, you know, for me, I just kind of keep an eye on the Fed. You know, there's two things that the Fed keeps an eye on, and their primary purpose is twofold. Price stability when we talk about inflation, but also to maximize employment. And so what the two measures that I keep an eye on to try to gauge of what the Fed is going to do is what's happening on the unemployment picture, but also what's happening in terms of inflation. You know, if we look back at what the unemployment picture is doing over the past couple of years, we can certainly see that it's been coming down. And so that's one of those things that makes you feel that, okay, the Fed is maybe getting a little bit closer to move. But then when we keep an eye on what's happening with inflation, we see that inflation has been relatively stable over the past couple of years. So there's a little bit of room for the Fed to continue to maintain this easing policy, but you know, just keep an eye on what's going to happen with inflation. But when we keep an eye for credit unions, you know, credit unions, you know, a lot of the times they operate within a specific region or a location. And so their membership may be based upon what's going to happen to their particular geographic region, not always what happens at the macro level in terms of the national economy. So there's a little bit of a mixing between the two pieces. So even if the U.S. economy is kind of humming along, if a credit union's, you know, their major employer is starting to slow down, maybe they're tied into the energy sector right now, then they may see their own overall loan demand, you know, slow down and deposit growth slow down, and it has nothing to do with the broader economy.
So with all of the concerns, what should credit unions do? If you had to give a little bit of advice to a credit union today, what would it be?
You know, I think that going forward, what credit unions really need to be doing is starting to use the reports. And I talked about earlier this risk-based decision-making process, to where a credit union is going to be able to decompose the risk that they have, be able to integrate it in with their expectations of the future in terms of economics, and then ultimately be able to craft some decisions, you know, upon what that's supposed to be going forward. And I think that they need to meld, technology and using, and getting creative along with, making those decisions. And that credit unions, they need to take some time and think outside the box. I look back to what other credit unions have done. There's some credit unions I've spoken with to where they created a relationship between a home builder or a home renovation company and, and tied in getting a mortgage loan with remodeling of that house, to where when you came in and you got a mortgage, they also had this preferred, company that you could do to remodel your kitchen or your bathroom or so forth. And what that did for the credit unions, they were able to put on that 30-year mortgage, but then they were also able to offset it with a little bit shorter product, maybe a 5-year, home equity loan or a home improvement loan. And so get creative, think outside the box. Credit unions don't have to do what it is that they've done over the last 5 or 10 years.
So looking forward with all of those concerns, what should credit unions do? If you had to give a little advice to a credit union, what would it be?
Yeah, if I were to break it down in the nuts and bolts, it's really two simple things. Neither of them are simple. Is that start putting together a risk-based decision-making process, right? Start to use your reports. Start to think about and form your own expectations for the future of where you think the economy is going to go, and then start to make some plans. How do you need to adjust your balance sheet in order to get there? And I always talk about getting creative with credit unions and credit unions that I work with. And one of the things is that we need to learn to do other things that we haven't done in the past. I always talk to credit unions about, you need to grow a particular loan type. And they say, well, that's fantastic. How do you do that? Use technology. Talk to other people. Talk to people, look at what people in other industries are doing. Is there anything in there that you can leverage that will make your credit union a little bit more competitive than some of the others? For instance, there's a credit union in Louisiana who they started coming up with a new mobile app, and they did a lot of advertising directly to their members on different loan products. And they saw a ton of growth out of that. I can't comment for anybody else. I happen to check my my accounts on a pretty daily basis, right? You have all these issues with identity theft going on, and is everything okay? And then what also I have is a pregnant wife at home. And she's shopping for the baby's room, and we're buying new baby bedding and also just stuff that I don't even really know what all it is. So sometimes it just looks like sometimes it looks like I got hacked, and I didn't. It's just like there's a little blip that shows up. But so I'm always looking at my accounts, and I see those advertisements on there. And for me, I'm looking at getting a new car here pretty soon myself. And so yeah, that matters to me. Other credit unions that I know, they packaged a deal with somebody that was doing, if you walk in to get a new mortgage, they had a company that did home renovations that they were working with. And so when you bought your house, they would also give you a discounted rate and package in a deal for a home renovation. Right, and so if you're buying a home that you wanted to do some remodeling on it, they had a list of people that they would recommend, and they would also provide funding for that. So get creative, think outside the box. There's no reason to rely on what it is we've done for the last 10 or 15 years and assume that that's going to carry over into the future.
Great ideas. Thank you, Mark, and good luck with that baby.
Thank you.
Before you leave, I want to ask each of you what credit unions might expect in 2015 and what they should do. Thoughts?
I'm optimistic. I think loan growth is going to be strong. I think we're going to see hopefully another 10%. That means I think credit unions really need to make sure they've got good liquidity to be able to fund those loan demands, also understand the pricing structure to make sure everything is profitable. But I'm optimistic. I think credit unions will have a good year from a lending standpoint, so that'll be good. Be looking forward to seeing that.
Serena?
I think the economy will be strong. I think in terms of investments, credit unions need to refocus on creating their ladder. They've kind of lost focus on that, but also be willing to look at other types of investments, mortgage-backed securities, which will give you cash flow and added yield. Just be real picky in what you spend the dollars wisely.
Yeah, and I happen to agree with both of them. I think that we're going to see a lot of strong loan demand over the upcoming year. I think interest rates are going to remain relatively low and very accommodative for credit unions and also for members alike. And there's a lot of time. So for credit unions that are trying to manage against the risk that they have on their balance sheet, they have time to restack their overall balance sheets. And so it's not something that you have to jump out and do today, but just start putting together a plan and something you can work at towards the future.
Thank you, Serena, Stephen, and Mark, for the collective wisdom. All this information is very relevant and should help credit unions prepare for the year ahead. I would like to thank our viewers for attending Catalyst Corporate and Catalyst Strategic Solutions 2015 Blueprint for Success. The video presentation will be available on demand and on the Catalyst Strategic Solutions website and on the Learning Center page, as well as the Catalyst Corporate website under Training. Education and training programs are an essential component of the value that Catalyst Corporate, as a cooperative, brings to its member credit unions and clients. Please plan to take advantage of all of the webinars planned for 2015, as well as the in-person conferences, the 3rd Annual Accelerating Success Conference on April 30th through May 1st in Las Vegas, Nevada, as well as the Financial Management Seminar and 38th Annual Economic Forum. That's scheduled for October 5th through 7th in Las Colinas, Texas. Again, thank you for joining us.